First of all, I wish you all a happy new year, but I'm not sure if we're past that now. Christmas seems like an eternity ago, and if anyone's doing dry January, it probably feels even longer, but only 4 more days to go before you can have a drink. Secondly, welcome to Pareto's quarterly markets update, again held in conjunction with Luna Investment Management, and we'll be looking at the latest financial trends, market developments and insights into the market. We'll also be sharing our perspectives with Chris on current market conditions, investment strategies and the impact they may have on clients' plans. For regular listeners, Alex will need no introduction. He's the Chief Investment Officer for Luna Investment Management with a number of accolades. He's also responsible for coordinating the overall investment strategy at Luna. Chris is one of our chartered financial advisors who's been with us a number of years. Chris also sits on the Pareto Investment Policy Committee. So if anyone's worried about their investments, these are the two that they can come and phone up and have a chat to. Chris specialises in advising individuals and owner-managed businesses in various aspects of financial planning, and he'll offer a different view on the perspective of markets from an advisory and client point of view. I think it's safe to say we've had a good run. There's positive returns in general across most portfolios, and we'll be looking today about why this has happened and what we think the implications going forward for clients' portfolios will be. And we'll touch on what's happening with some of the AI, and we were just discussing that before the webinar started. So I think it's fair to say, since COVID, we've had a number of economic and political pressures, not only the US and UK elections, but also elections worldwide, which we've discussed in previous webinars. The Israel-Palestine conflict, which looks as if we're moving forward with that, Ukraine, Russia, and the impacts on markets and volatility since COVID when we first started these webinars. I'd like to reiterate, those are doing all presentations, the importance of having a portfolio that reflects your risk and volatility. And volatility isn't necessarily a bad thing. And what we like to do is, the way that we advise our clients to invest, we actually want some volatility in clients' portfolio, so investment managers such as Alex can take advantage of the peaks and the troughs. So obviously selling while the market's high and looking at buying at value. Before we start, and we've got a few questions and answers that some of our regular listeners have sent in, I'd like to just start with some housekeeping. Can we please make sure that all of our computers are on silent, just to mitigate any background noise. The presentation is being recorded. This will be available on various channels and social media channels out there. We've also got Pareto's YouTube channel, so we're going forward with our IT and digital marketing change. The questions and answers session should last around 40 minutes. And if there is anything you'd like to ask either Alex, Chris, or myself, please feel free to use the Q&A button at the bottom of your screens. So without further ado, Alex, would you just like to touch on what's been the response with the markets with regard to the October budget?
Yeah, morning everyone, and Happy New Year. Thank you, Stuart, for the introduction. God, it feels like we're still talking about a budget. It was 3 months ago. It's pretty rare that. I think the first thing to say, there was definitely a bit of nervousness going into the budget in terms of people delay making decisions because they didn't want to come out of it, and there was going to be a budget for change. Since then, my sense was that economic growth has deteriorated within the UK. You've got consumers which are now not making decisions. You've got businesses that have stopped hiring. So you've started to see the unemployment rate start to tick up. You've seen not as many applications for jobs, and it's still having a big overhang on the economy. And we know the reasons for that, the increase to national insurance being one, but it goes outside that. There's big employment changes that are coming down the pipe within the UK as well, and I think it's just added to another level of complexity. So since the budget, the UK economy is basically stalled. You've seen a couple of months of minus 0.1% economic growth, and just going to share a slide and maybe touch on the other implications for the budget as well, because there's definitely a transfer going on at the moment from the the private sector to the public sector, and that's essentially what the budget was designed to do. It's rebalancing from taking money from the private sector in terms of national insurance increases, and it's putting that money into the public sector. So it's forecast this year that the UK economy is going to grow about 1%, which I suppose is better than zero. It's below 2%, which is trend growth within the UK. That's the left-hand chart there. You can see the different components that make up GDP from 2012 to 2024, and obviously the COVID spike. And then the problem with GDP data, and I touch on this most times when I speak, is it's always announced with a bit of delay. We haven't actually got the fourth quarter data yet. So what we spend a lot of time looking at are these purchase and manage indices, which is on the right-hand side, and they're surveys done which give a good indication of what's going on with the economy right now. Services, the purple one, is probably the most important because we're a service-based economy. And you can see there that since the beginning of the year, as 2024 started, it was pretty strong, but as the year progressed, it started to deteriorate, and it's just accelerating now. Whereas in manufacturing, you can see it's actually gone below 50, which means it's contracting at the moment. So, in summary, the UK economy has been pretty stodgy since the budget, and it's having big implications for the economy, but it's also having big implications for personal circumstances as well.
So thanks, Alex. So Chris, how do you think clients have reacted with regards to the budgets and the implications on their financial planning?
Yeah, I think I don't think it's been taken too well. It's been a pretty anti-business budget. We've obviously got a lot of business owner clients, and as Alex already touched on, there was a bit of a triple whammy for business owners. There was the national insurance rise, but on top of that, we've had changes to business relief, so in terms of inheritance tax, but also capital gains. So a lot of the kind of response from clients has been pretty negative. That kind of it's been a tough time with COVID, and then with interest rates increasing, and just as it felt like there might have been a bit of momentum coming out of a new government, things were looking a bit rosier. It feels like it's just been kind of shoved back to where it was going. So the response hasn't been great. I think as you touched on, Alex, there was quite a lot of speculation in the run up to the budget of what they might do and what they wouldn't do. And in some aspects, there were, I think, things that weren't as bad as expected. Capital gains tax was obviously spoken about, but potentially going all the way to 39%, and that didn't kind of go as high at 24%. We had lots of speculation on the pension side of things around kind of tax-free cash being taken away, which seems to always be the case. But again, that didn't happen. But then there were certainly some pretty heavy-handed changes, throughout. So yeah, the response has been great. I think what's definitely, especially with the changes to the pensions, with inheritance tax, and that now forming part of the estate, I think it kind of highlights the need for really personal advice, because you could generally work on a rule of thumb previously that you leave your pensions because that will pass on efficiently to the next generation, spend your other assets. But really now it's every case is different, every client's different, because you're starting to talk about children's and grandchildren's potential income tax rates, and do you take money now and pay tax? And from the meetings I'm having with clients, we're explaining the information and the changes, and actually there's different planning for every single client because of the different situations. So it's certainly been, as you said, Alex, we're still talking about it, 3 months later. I think with a new government, that often is the case. So yeah, it's certainly been a big impact, and we're working closely with other professionals, solicitors, accountants, with updating wills, and really we're saying it's an opportunity for a bit of a head-to-toe review, both business and personal, to kind of adapt to the changes.
And I think that's one of the key things at the moment. What I'd stress to any clients out there or introducers that may have clients, now's the perfect time that we're going to have a review of clients' financial situations. One, because of the markets are still bearing up. They're still quite strong, even if we have a look at low inflation. The markets, in terms of the stock markets and funds, are holding up. So we can have a look at some cash flow planning, but also have a look at, as you say, the changes in the budget with regards to inheritance tax implications, both on business, farmers, and pensions. Yeah. And do some of the simple things that we always stress: get some life cover in place, do some cash flow planning, and look at where we can move towards in terms of future goals and priorities.
Yeah, absolutely. I think in the past, especially for business owners, that things could be left, and knowing that the business will pass on without inheritance tax, and then same with pensions. But I think now there's a lot more need for proactive planning. Is that starting to restructure the business, in life as opposed to waiting? And yeah, it certainly needs some big decisions to be made, and some proper planning to be done with the changes coming in.
Yeah, and I think the other thing as well that I was going to just touch on, a lot of this hasn't even come into force yet.
Yes.
So we got the national insurance, which is from April, and it's how do businesses react to that? Because businesses are getting squeezed. 20% of listed companies in the UK have had a profits warning on the back of the increase in national insurance, and there's some pretty large numbers that are coming through there, which is why you've seen this freeze on recruitment. And inflation has been a problem the last few years, and I can see over the coming months that prices are going to start to edge up, particularly on retailers, because they're going to be trying to protect margins. And I mean, we're not going back to the inflation that we saw 2 years ago. Let's not get too concerned, but it's going to definitely be a little bit stickier within the UK, which is going to cause, I think, the Bank of England a concern as well. Because, sorry, go on.
There was just news in the paper this week about we've seen a 6% increase in insolvency rates from businesses within the UK. So there's things that are happening in the budget that are definitely having an impact out in the high street at the moment.
Yeah, and the hospitality industry as well. You see restaurants closing left, right, and centre because of these factors coming through as well. So it's definitely having an impact on the economy.
So we mentioned inflation. What do you think the impact will be on the Bank of England cutting interest rates? Because we've heard about Donald Trump this week threatening the Federal Reserve about reducing rates, which you would think would have a knock-on effect throughout the world and some of the other developed economies.
Yeah.
So what do you think will happen with regards to the Bank of England cutting interest rates?
So I think the first thing to point out there is that all central banks are independent from the government. That's set up on purpose so that presidents don't get what they want, because they're just going to stimulate and force the economy and get, but not think about the other consequences that they have. So that's an important point that we should remember. In terms of the Bank of England, I mean, we did see inflation temporarily fall last month, and it's around 2.4% CPI in the UK at the moment. The next meeting is at the beginning of February, so in a couple of weeks' time. I think they'll cut then. I think it'll be another 25 basis point cut then. So we'll go from 4.75 down to 4.5. As I said, I think inflation will then start to creep up. We'll probably get to around 3% by spring. And most forecasters are saying that there's going to be 4 cuts this year, and they're going to be quarterly. So it'll be February, May, April, and November, because they get 4 reports on those meetings. So they're the 4 that we're looking at to do. I think it'd be difficult to go in May if you've got inflation at 3%. By the summer, it might be starting to come down. So I think you probably get 3 interest rate cuts this week. What's been interesting though, the Bank of England have got a new member on the Monetary Policy Committee, and he said that he thinks the interest rates need to come down by about 6 more times, so 1.5% off where we are today. So taking interest rates just to 3. I mean, our long-term view is that interest rates should be a natural rate of 3 to 4, so kind of 3.5 being the new normal. We're not going back to the days of the financial crisis of 0. Equally, 5.5 is probably a little bit too high. So around that kind of 3 seems a little bit better, and that makes sense. You should have a positive interest rate. There should be a cost of debt, and that's what was wrong for such a long period of time. But I mean, that again, back to the investment perspective, that has an impact on clients, because a lot of clients have been using cash because you've been getting decent returns for the last 2 years of north of 5%. In a year to 2 years' time, that could be closer to 3.
Okay. So, Chris, with regards to that, clients that have reverted to cash, and they have been looking, I mean, I had clients at 6.5% going back over the last couple of years on a 12-month fixed interest rate period. What should clients be looking at doing if they do have money sat in their own personal bank accounts, or alternatively, even companies that are sat in cash for the difficult times we discussed previously?
Yeah, I think as you touched on, it wasn't long ago, I think there was a 6.2% rate from NS&I, and at that point, all clients were talking about was cash, it felt like. We've already seen, even though I think rates haven't come down as quickly in terms of the bank rate, the cash rates are coming down. I don't think you can really find a 5% 1 year anymore. While it's still hovering in the 4s, I think clients are see that as a good deal. But chatting with clients, I think as soon as that starts to begin with a 3, that's the point that they start to say, can I get a better return than that? I think it's been painful to get to where we are in terms of the rates going where they went. But as you said, Alex, we're now in a position where you are getting a real return on your cash, and that's how it should be. So actually, for a lot of our clients who, part of our planning is to make sure you've got sufficient cash set aside for rainy days or to kind of supplement income needs, that actually getting paid on that has been good. Obviously, on the flip side, with the clients with mortgages and who are having to kind of remortgage into those higher rates, it's been frustrating. So it's looking at, if there's cash set aside, do we pay money down the mortgage, and that decision around investing for the longer term or paying down the mortgage, again, that's certainly come to the forefront again. Whereas pre 2022, when mortgage rates were at 1 or 2%, it was a bit of a no-brainer to just keep the mortgage and invest, especially if you've got a long time horizon. But we're certainly having more instances of discussions with clients and saying, we've built up quite nice pots that they've done well over the last few years. Do we actually dip into those to pay down mortgages if we're remortgaging to higher rates? So the decision around investing or paying down debt or keeping cash is a bit more on an even keel now compared to kind of a few years ago. So yeah, we're certainly kind of having constant chats with clients around, the big question is, when might you need that cash? And
Yes.
And really, it's all around your time horizon. If it's nice that you're getting 4% on cash, but if you're not going to need that cash for 5+ years, then you can afford to invest that and likely get a better return over the longer run. So a lot of it is down to what's the cash for, when might you need it, and that will drive the decision, probably less so than actually what the interest rate is. It's nice we're getting paid a bit more, but the driver should really be, well, what's the cash for and when might we need it?
There are alternatives to cash in terms of making sure they're in the correct tax wrappers, so you mitigate any income tax that potentially you would be paying on the return. Because when we're talking about 4.6%, if you're a higher rate or additional rate taxpayer, we're actually be talking in the mid-2s, which is only in real terms what we're talking about with inflation, which you touched on before.
So in real terms, you're getting nothing.
In real terms, you're getting nothing. So there's the structure of what you're holding the cash in, but there's also alternatives in terms of some of the bonds, and I know you've touched on those previously. So how are bond rates coping, Alex?
Let me just share a few slides, because I mean, this is for regular viewers will know this is my favorite subject, so apologies if we're going through this again. But just to skip through a few slides here. That'll work. Yeah. Inflation, we touched on that, we touched on interest rates. We need to go back, actually. Let's just touch on this one here. So this is just what happens to bond markets in 2024. I thought this was a good way to frame it. And we're going to focus in on that blue line, that's government bonds. And you can see that the bond market was doing pretty well until September. And then from September, the bond market really sold off. And that was a few things. That was on the Federal Reserve saying that interest rates probably aren't going to be coming down. You've had a raft of strong economic data from the US, which suggests that they don't really need to be bringing interest rates down. And there's been a lot of focus at the moment about, is the UK going through a mini budget Liz Truss thing? But because bond yields have increased, but they've been increasing globally. The UK is no different to what's been going on with global markets. And it's a really important point. I think the press are just trying to get some headlines at the moment on the back of that. And then on top of that, you've then had Trump come in, which is perceived by the market so far as being very reflationary. He's going to try and extend economic growth. Inflation is going to be stickier because of some of his policies. So you've seen kind of 2 hits to government bonds over the last 4 months, which is really taken off the gains that you saw through the whole of the year. So you held a government bond last year. This is just a normal government bond. It's about duration of a bond about 10 years. You lost 4% last year. But what we've been talking about a lot over the years, sorry about that, we'll come back to that maybe a little bit later, giving a little bit away there.
Was that you at the Christmas party?
It was. Is shorter dated government bonds, and my favourite chart, my favourite table, sorry. So because bonds, there's the expectation interest rates might not come down as much, you've seen bond prices come off a little bit more, and therefore this gross redemption yield column here tick up a little bit. Not a lot, but just a little bit. And just to remind people that maybe haven't seen this before, these are bonds issued by the UK government. There are a variety of maturity dates. You can see this one. Let's just do the 0.5 one here in 2029. So this one matures basically in 4 years to the day. You'll be getting an annual coupon of 0.5% because all these bonds will launch when interest rates are really low. And that's fixed at the launch date. So because that can't change, the price changes, because 0.5% is now not very attractive compared to where it was 5 years or so ago when it's launched.
Excuse me.
So you can pick up this bond today at £86, and bonds are launched at, government bonds are launched at 100 and they mature at 100. The only way that they wouldn't mature at 100 is if the government defaults. And hopefully, I think we can all sit around this table and think there's a very low probability of that.
And even if it did, everyone's in a bad place then.
Exactly, yeah. We'll all be in the hiding under the stairs or whatever in the bomb shelters. So what happens then is you can see here that you get an annual return of 4.19, which is that next column there. And that combines the bond price recovering to 100 and that annual interest that you get. And that annual coupon is taxed at income tax. But the majority of the return you can see is from the price recovering back to 100. So you're getting a 4.2% annual return. Now, the beautiful thing about that price going back to 100, well, Chris, you want to say it's your...
Well, that element of it is effectively tax-free. There's no capital gains tax on that price movement. So as the columns to the right-hand side suggest, the kind of equivalent cash rate you would need, factoring in, you know, as an example, if you were a higher rate taxpayer, for that one, which was for 2029, you would need pretty much 6% on cash, factoring in that, as you touched on, Stuart, that you would get 40% tax taken off of that. So as I touched on a moment ago, you know, when we're looking at available cash rates at the moment, they're all starting with a 4. So for something like this, you know, it's after tax and charges, it certainly looks like a good opportunity. And the beauty of these is, you know exactly when they're going to mature. So it comes back to that comment about, you know, what's the cash for and when might you need it? Where we use these a lot with clients is often for a tax bill that we know we're going to need it in January or July element. So we can effectively line up a gilt to that point. We know that we're going to get our cash back in time and actually get a pretty good effective rate on it. So,
but I think it's also worth mentioning that these are tradable and liquid.
Yeah.
So you're not tying your money up. It's not a 12-month, 3-year, 5-year term plan.
Yeah, these are the most liquid investments in the market, and they settle on a T+1 basis. So you sell it today, you get your money back tomorrow, and you can do that throughout the day. They're the most liquid investments in the UK market, even more liquid than, you know, someone like BP or Shell or something along those lines. So yeah. So
for anyone that may have a tax bill next January, I know that we've used this for a lot of clients to pay a tax bill. And for anyone who hasn't done the self-assessment, you've got 4 days to go. I spoke to an accountant yesterday, and she still hasn't done her self-assessment. And we were talking about making sure it's not a decorated front room. But you can see here, there's a Treasury bond right there that's offering about 4.6%. So roughly about 6.2 to pay your tax bill in January 2026.
Yeah.
Good. So there are alternatives to cash. In terms of where we think the markets are going to go, and you touched on just Donald Trump before, and you gave us an insight into his dance. So what do you think the impact of Donald Trump will be, both in terms of the markets, but the knock-on effect throughout the world?
Yeah, I mean, it's been a quiet 4 years of not talking about Donald Trump, and we're about talking about him again. So, I mean, let's start with the various policies maybe and just work through them one by one. The most obvious one to start is tariffs. There's tariffs been proposed on Mexico and Canada to begin with, because they're concerned about the borders, basically, or he's sorting out the borders. China's the next big one. I think, and you've already seen it over the weekend as well, which are being rolled out and then rolled back on. So I think that was a good, interesting insight in terms of how tariffs might be used. I think they're going to be used as a bargaining chip in terms of Trump getting what he wants. If he doesn't get what he wants, he's always going to say, and he's already said it to Russia as well, that tariffs are coming and more sanctions are coming. So I mean, it's interesting that, you know, when he said he's coming into office, that that was going to be a day one thing, and they haven't come down the line yet. And it's, you know, it's only a week or so in now, isn't it? If that, but it's not come. So tariffs will be used as a threat. Tariffs are inflationary. It's how other countries then retaliate, which could cause a trade war, which we saw in 2019 as well, between China and the US, and that wasn't a good period for global markets. And as I said, it's
And 2050.
Yeah, sorry, yeah. So it's not a good period for markets.
Yeah.
And it's inflationary, so it's bad for the economy as well. So that's not good. In terms of it, but the reality is, and I'm not a big Trump fan, but the reality is markets are taking this news very positively, because as I touched on, he's reflationary, he's pro-growth, he's pro-stock market, he's pro-investment. He wants to cut corporation taxes down significantly, which is what he did in his first time in office. And if you do that, then it's very strong for earnings that are reported in the US. So it's a positive for US companies. And maybe I'll touch on it. So we did make some changes to portfolios after the Trump election. We bought some US smaller companies just because we felt that they'd be best placed to benefit if tax rates do come down. So that's a positive. There's also geopolitical issues that we need to be thinking about as well. You're starting to see wars kind of declimaxing or coming down. I don't know what the right word to do. It's in tensions. You're seeing it in the Middle East already. There's been some strong wording about Russia as well in terms of things coming, tensions de-escalating. And that's a positive for commodity markets, which is what we saw when Russia invaded Ukraine. Oil price spiked significantly, natural gas prices spiked significantly, because wars tend to be bad, and obviously bad, but bad for commodity markets. So then de-escalating is a positive. What else is there that we can touch on? I suppose there's the focus on the US first in terms of that policy as well. That can't be good for the global economy, but it's probably good for the US economy. US economy matters for global markets, but so do other markets as well. So I think that's kind of what you win one way, you lose another way, kind of balances out. And I think the immigration policies, they're bad for the economy. You want net migration into an economy, because then you have more people working, you have more people benefiting society, you have more people reduces inflation. Yeah, exactly. And now you're going opposite of that. So that's actually, I think, going to be a bit of a negative for the US economy, which is probably controversial, but it's something that, it's just fact in terms of more people in the economy. As long as they're contributing, the better society is.
Is it worth touching on? You mentioned the US stock market and the strength and the impacts it may have, but you mentioned about the top 7 in the UK. We've had the impact of AI and Nvidia that's taken a hit of 500 billion.
Yeah, it's you do these slides and you get one of the biggest moves on a daily market on a day. So just give me a second. I'm just going to get this slide open on Nvidia as well. Okay. So excuse me a second. So as Stuart was just touching on here, on the right-hand side, you can see the breakdown of markets. So you've got the top 10 in the US, which is that green line. You've got the grey line, which is the remaining 490 in the S&P 500. And that's the P ratio. So as that line moves up, companies are getting more expensive. As that line comes down, it means companies are cheap. Companies tend to come down when bubbles burst in valuations, or things have just gone a bit too stretched, or there's a recession, etc. And companies tend to get more expensive as the economy is recovering and doing well. On the left-hand side, I just want to show what earnings growth is going to be. And you can see there that through 2024, those green bars dominated. And that's the earnings growth coming from those top 10 companies. And that's why those companies have done very well in share price terms. Nvidia is now the biggest company in the world at 6% of the S&P. But you can see through time, it's difficult to keep growing at that pace. Are people still going to be buying the same amount of chips? Are people still going to be buying the same amount of infrastructure, etc.? But the other remaining 490 are now starting to come back and starting to grow a little bit better as well. So overnight, or the last day or so, you've seen a Chinese artificial intelligence company, what's it called? DeepSeek, isn't it? DeepSeek come through, which has said that it's basically a ChatGPT rival, but they're doing it at a cheaper way, using less chips, using less energy. And it's really caused a lot of and also getting strong results on the back of the information it generates as well. And it's definitely caused a lot of volatility, because the market's looking, so, well, do I need to, are people going to be buying as many NVIDIA chips in the future if you can do it cheaper by this Chinese way? Now, it's very, I mean, so on the back of that, NVIDIA shares were down 17% last night. And at 6% of the S&P 500, a 17% move, that's, you know, taking 1% off the S&P alone last night because of how big NVIDIA's been. Now, on the right-hand side, there's just something we're always mindful of. When a company becomes as big as NVIDIA and becomes expensive, because it deserves to be expensive to a certain extent because it's been growing so quickly, etc. But as soon as there's certain doubts about that growth into the future, it gets hit. And there's no hiding place when it's expensive. And that's what happened last night. NVIDIA's expensive. You can argue that it deserves to be expensive, but if people are now worried about its prospects in the future, that's why it's been hit so quickly. Who knows? I don't have a crystal ball. I don't know what these chips are going to be like. I'm not an artificial intelligence expert in terms of what this Chinese company DeepSeek have done in terms of being able to deliver, but it's certainly rocked the boat. And that's maybe not a bad thing. It's a bad thing for companies like NVIDIA, but for other companies that are looking to adopt artificial intelligence, if there's now a cheaper way of being able to do it, then great. I think the other point that maybe we've overlooked so far, and it's probably a bit controversial to say this is a Chinese company. Now, how many concerns are being mentioned about Chinese infiltrating our intelligence networks, etc.? You've got concerns. TikTok was nearly banned in the US for a short period of time. There's a lot of concerns about this. So I think it'd be interesting to see how governments respond. And there's no legislation around artificial intelligence at all at the moment, which is probably wrong too. So yes, it's early days. It's certainly not the NVIDIA off its peak, and you can see the reasons for that. Is it too early to say? It's probably too early to say if that's going to be sustained though, and if they're going to stop seeing demand. It's actually interesting. They're reporting their earnings this week, so we'll find out very early on. This is historically what's happened over the previous quarter, but we'll get an indication this week, and you might see things stabilise a little bit if they report strong earnings this week.
Good. So that's at macro level, and clients fundamentally can't do anything on an individual basis with that. But what should clients be thinking about doing, Chris?
Yeah, I think as you touched on, Alex, the point you made that you haven't got a crystal ball, it does highlight that trying to forecast with any certainty what the impact of certain things may be is tough to do, and to then make decisions around what you do with your money or how you spend your money, again, it's you can end up losing out in the longer term. I think probably what happened overnight or last night highlighted that often it's the things that no one was expecting is what rocks the markets. Is everyone might be talking about Trump and this and that, and then it's often something that comes COVID or something like this that just comes completely out of left field, and in a way it highlights that we just have to try and think in the long term. I think Donald Trump coming back in, the conversation we've been having is this time there's he's a bit more of a known entity compared to previously when it was 2016. I think a few years before that, had someone suggested that Donald Trump was going to be the next president, I think it would have been a complete shock. Whereas now it's a bit more of a he was in the run up to it, he was predicted to come in, and we've had 4 years of him, so I think there's a little bit less uncertainty in that side, and that's kind of what we're speaking about with clients. But really it's about trying to think long term, because you look back over the last 10, 20, 30 years, and there's been numerous different presidents, different governments in the UK, all with different policies, different threats, wars, etc. And companies and markets find a way to keep trudging along. And that's where it harks back to that. What's the cash going to be for? Are we able to ride out this volatility? I certainly hope I won't have any clients ringing up saying, do we need to be selling or doing anything, on the back of last night? But it opens up conversation around what are your cash needs in the coming years, and we've had a good run in the market. So actually, is it a time to start earmarking funds for paying off the mortgage in a couple of years, or a new car that you've got in mind? So it's about, I think, trying to move away from the short-term thinking and just review the plan as always and make sure that we're on track. And short-term share price movements will have some impact, but it's making sure that you're well positioned, that you're not all just in the US, that you're in a diversified portfolio. Because I think, as we saw last night, NVIDIA was down nearly 20%, but there was other areas of the market that were up. So that's where it's about not having all of your eggs in one basket. And certainly the way we invest for our clients is absolutely making sure it can be painful at times, and they might say, why are we still investing in the UK when the outlook isn't as good? But its time will come, I'm sure, and that's where having that balance is really
I
important.
think it's Warren Buffett old philosophy of swimming against the tide.
Yeah.
So when the markets are high, you look at consolidating your position. When the markets are low, it's an opportunity. And one of the things we discussed the other day, Chris, in the office, which was just my thoughts when you were talking then, is advising clients not to react to the market. So when something happens in the markets don't mind bad news, do they, Alex?
Yeah.
They love good news. What they don't like is this uncertainty.
Yeah.
And the problem that we have as advisors with clients is making sure that we don't react to it. So let's not sell while the markets are low, and let's not get too excited when the markets are high.
Yeah, no, absolutely. I mean, that's what, one of my biggest frustrations is that everyone wants to talk to you when the market's had a good run. So the last month or two, we're getting very strong inflows into Luna again, which is great. We haven't had any outflows. But people don't want to invest when there's uncertainty, and that's always the best time to do it. Go back over the last few years. March 2009, middle of the financial crisis, low with the FTSE 100. March 2020, just as we're going into the national lockdown, lower the market. So exactly that. I mean, we use opportunities like that to take advantage and add risk, because it's going against what other investors are doing to be able to do it. We haven't decided to do it just yet, but one of the things we're thinking about is dialing down risk a little bit. We've had a very strong run in markets, particularly the US, which touched on, but other markets are doing pretty well. So, all in all, markets are doing well, but they're not stretched, I'd say. I mean, just one of the points is hopefully give a bit of confidence that when we're looking at bond markets at the moment, as a highlight of government bonds are pretty attractive, but equity markets are pretty attractive as well at the moment.
And the markets are holding their own at the moment, aren't they?
Yeah. I mean, the FTSE 100, who would have thought it, with all the negative news that you hear about the UK economy and the UK budget. But remember, the FTSE 100 is not a reflection of what the UK economy is. It's a reflection of the global economy, and it was hitting all-time highs. The FTSE was up yesterday, one point, I think it was, 0.01%.
Better than being down 1 point.
Exactly. But it's up again today. So that highlights the benefit of diversification. Bond markets actually had a strong day yesterday as well, because if there's a bit of worry within the market, they tend to go to government bonds. So they were a bit supported yesterday. So yes, it's going to grab the headlines that the US had a bad day, but other areas did okay. And that's highlights Chris's point about being well diversified, not just being in one market. And we've seen it, and maybe Chris sees it probably more so than me, but a lot of our peers and competitors have really capitulated and just thought, oh, the US market's done 20% the last 2 years. It's the only market to have. And so I just think that's fundamentally the wrong thing to do. It's about having a mixture of active and passive managers that can help offset that. As I said, we've been focusing on the smaller part of the market because that's where we see value. So we do like the US, but we're just being very selective about where we're buying within the US at the moment.
So, good, thank you. So what do you think clients should be thinking about, Alex, in terms of investing going forward? So we're in a good position at the moment. Most clients' portfolios are at a level where they should be quite pleased about. What do you think clients should be thinking about right now?
Well, I think that's down to each individual person, to be honest. It's what's their time frame is, how much risk that they want to take, how much risk are they willing to take. If you're willing to invest for Chris, 3 to 5 years, then I think it's still a good time to be investing, whether you're a cautious or a high risk investor. If you're willing to take an even longer term perspective, as Chris touched on, we've seen the FTSE 100 half from 2007 to 2009, and it's still higher today because markets just evolve and change and battle through these things. So I think there's definitely opportunities to be invested. So I wouldn't be worried if it was. Market's a little bit higher. So you're not going to make the same returns that you did last year, obviously, because you're starting from a higher point. But we still see decent opportunities for market. I'd probably throw that one back to Chris, to be honest.
Okay, thanks for that. Yeah, same question. What do you think in terms of the advice that we would be giving to clients right now? What should clients be thinking about, both personally, but also on the corporate side? Because I stress, when I'm seeing clients, there are a lot of owner-managed businesses that are sat there with a lot of cash, and we don't know, but looking at the facts and figures, institutions expect cash rates to come down. We've touched on inflation edging up. So there is this issue around cash is probably not going to grow in real terms. So what are the opportunities out there?
Yeah, I think it's a lot of conversations with the clients at the moment. Sometimes because we've had a couple of good years, if there's cash that they've got set aside that they might invest, a lot of it kind of is the fear that, oh, but surely we're at highs. That must mean that we're going to now have a bad year. And actually, when you look at the evidence from history, just because you're at an all-time high, it's not necessarily a bad thing. Everyone always thinks of kind of an all-time high as the one just before it then falls off, like 2009 or 2020. But actually, last year I think there were 50 odd all-time highs in the US, and all-time highs tend to lead to more all-time highs. So it's sitting with clients, and again, coming back to that, we're not trying to time the market or find the best, because you could end up. I've had clients say kind of a year and a half ago, let's just wait because I'm sure there's going to be some better opportunities, and the markets have just gone away from there. So it's trying to get away from that. Let's time it at the right time. Let's just stick to the plan and establish, well, what is the long-term goals and objectives, and what's the best way to achieve that. And looking back, it's if we do have a long enough time horizon, you're going to get your better returns from being more in equities, but being cognizant of the fact that if you do have a short-term cash need, that you certainly don't want to be taking too much risk with it. Touching back on the corporate side of things, I think a lot of it comes down to what's that cash for, and as you touched on, businesses have built up cash over the years, but then it's looking at options like is the cash needed within the business? So are we keeping it there for working capital, or is it potentially to grow within the business, or are there opportunities to actually benefit from that personally by putting it into pensions, or depending on your tax position, drawing it out? So really, it's as you touched on, the markets are where they are, but every individual circumstances are different. So there's certainly not a one size fits all as to because we're here in the markets, this is what we should be doing. A lot of it comes down to those specific circumstances.
And I think you're right to distinguish one side of the fence. You've got the return, which is, Alex, that's your domain in terms of the investment management side. Been working with risk and volatility, and a lot of the time we're working with the tax side. So again, it's great maximising return, but you've also got to minimise the tax that you can pay. And things such as ISAs, pensions, even a business can be seen as a tax wrapper. So it's making sure you've got the right investments within the right structure.
Yeah,
absolutely.
Yeah. And just coming back to that point there that you mentioned as well about markets hitting all-time highs. Markets should hit all-time highs because earnings. What drives markets over a long time is earnings, and earnings go up year on year because you've got GDP growth and you've got some inflation coming through. So a little bit of inflation is not a bad thing from a company perspective. So, but in theory, if markets were smooth, you should have an all-time high every single day, and it just goes like that. Obviously, that never happens because you get events. But so no, I don't think having an all-time high is something to be concerned about. And if anything, as Chris touched on, it's a positive sign that the market's performing well.
Good. So we've got a couple of questions and hopefully we can answer these. So just coming through, will the pensions IHT changes in 2027 undo all the success of auto enrolment for private sector employees? I think that's probably more.
Yeah, it's a good question. I think over the years there's always been a bit of a fear or misunderstanding of pensions, and the worry is they're always tinkering with the rules and changing them. Auto enrolment has been a massive success, by effectively, having it as an opt-out. If you don't want to be in, you've got to opt out, as opposed to opting in. The majority, I think it's 90% plus, will stay in their workplace pension, and that's the best thing for them. They're effectively getting free money from the employer. But as the question suggests, especially younger people, I think when you see how long you might have to wait to get your pension, and then you see that they're changing the rules all the time, there is the fear that if they do keep tinkering with it, that and you see it and you hear it from people and say, oh, I don't trust pensions, and I'm never going to get it, and whatnot, and I think that's why they have to tread a really, really fine line here, because if they are constantly tinkering with it, it won't just be younger people in auto enrolment. It will be a lot of people who are just saying, I'm not going to bother, because we can harp on about the tax reliefs up front and the benefits and the free money, but at the end of the day, if the government keeps showing that they're just going to keep changing the rules, and often not for the better. It's not that they're, in recent years they've been, giving out handouts and that side of things. So it's certainly a risk. Hopefully that, you know, as I said, the nature of auto enrollment, because it is opt-in, a lot of it is just that people don't even get round to opting out, and that might be enough to keep it where it is. But certainly, if over the next number of years, you know, further changes come, or if the retirement age keeps getting pushed further down the line, then yeah, it certainly could be an issue.
I think it's worth bearing in mind the average pension pot at retirement is a lot less than what the nil rate band is. I know you have to start including things such as residential property, so it will have an impact. A lot of it might be headline grabbing, but in terms of the working man in the streets, not going to have a huge impact. But also remember that pensions are there primarily to give you an income at a certain point in your life. Pensions weren't there as a tax mitigation in creating a legacy from generation. So there are things that we can do, and I know legislation changes and it annoys people when they've built up for those tax implications, but there are things that we can do to help pay that tax bill, such as a simple life cover or a simple life policy can help people and mitigate the inheritance.
Absolutely, and I think at the end of the day, you have to just plan for what we know and what the rules are. I think what we learned from the recent budget is not to act on speculation, because a lot of what was speculated didn't come through. And it's the same with kind of even the changes now. You know, we can only work with what we've got. We plan for what we've got, and you know, we can assume they might keep tinkering with pensions, but maybe they don't. And really, it has to be I keep going back to it, but it's personal to every individual. You know, someone who's going to get generous tax relief, and you know, regardless of the IHT changes, it likely is still in their best interest to keep accruing in a pension. But often it's more of an education piece around both pensions and inheritance tax, because I think, you know, we see it. You know, inheritance tax is one of the most hated taxes out there, yet only a very small portion of people will ever pay it. So a lot of the time it's about just educating as to, you might not even pay this, and therefore, you know, let's not start making potentially damaging decisions here for something that likely will get changed again by the time we're there anyway.
And I think the person that asked the question, any changes aren't coming in until 2027. There was supposed to be a white paper, a discussion paper, excuse me, in December that's being kicked down the road. So obviously there is pressure around pensions and the impact on potential inheritance tax.
I think I mean, there's pressure on the government full stop. I mean, the government came in, this is about economic growth, and the one thing they've done is send it the wrong way. So Starmer's meeting with some business leaders again today, just to try and get some ideas about stimulating the economy, which is a positive, definitely. But you know, so far there's definitely been a negative impact from the decisions that have been made. But we need to get the economy growing. We need to get the economy back on track. We've got political stability in the UK. We haven't talked about political instability in Europe at the moment, but you know, we're the poster child of some political stability for the first time in 15 years or so.
Well, I think the David Smith thing. David Smith gave the presentation at the recent Lunar annual event, and he was saying, who would have thought 18 months ago that the markets would be looking at the UK as being the stable investment element throughout the world.
Yeah, absolutely. Yeah,
I think sometimes as well it's easy to, you know, go through some, you know, what feels like a negative moment with the budget, and you know, everyone's a bit downbeat, and then just extrapolate that out that it will just continually being negative. It's a bit like back, it feels like in a way a bit like 2022 when, you know, energy prices were going up, rates were going up, and you know, everything was so negative, and actually even it being less negative is sometimes enough to just keep things ticking along. And maybe we'll get that again where we've had quite a big change in the budget, and all it might take is a bit of positive momentum, maybe some better policies from the government, but actually a lot of it is about confidence for business owners, for people to spend their money, and that might be all it takes to just get a bit of positive momentum back. So I think, as you say, that stability is important for, you know, and maybe if at the next budget they kind of do nothing, that could give a bit of confidence to everyone that maybe all the bad stuff was coming out at the start, and let's actually plan now based on a bit of certainty for a few years.
Chris is the optimistic person on the
investment. You have to be, don't you? At the end of the day, you're being a pessimist when it comes to planning or investing. Otherwise, you know, you wouldn't spend your money, and you wouldn't live, would you? So.
No, I think that's fair. I think as you go through the course this year, people got short memories. So 3 months ago, people are thinking about the budget. in 3 months' time, are people still going to be thinking about it? Maybe, but I think there's a lot of people that will be a little bit sore and a bit angry, and it's very, very topical. But in 3 months' time, that pain becomes less. And as Chris said, people just move on with their lives and people adapt.
Yeah, and legislation is constantly changing. Have
Yeah.
a look at legislation changes. You mentioned auto enrollment. That was a legislation change back in 2012. So legislation is constantly evolving. It's just what we deal with on a day-to-day basis that we have to make sure clients' policies and investments are flexible enough to be able to adapt for that.
Yeah.
So just a second question, just around AI. What do you think the impact will be of AI looking forward, and can we take advantage of it?
I mean, yes. I think let's start with AI. So I think there's a few different periods that we're going to go through with AI. The first is the development of it. So this is where you're seeing all the chips, the data centers, the energy, etc., that's the kind of stage we're at now. The next stage is, which probably started and maybe been in for a year or two, is the ChatGPTs. It's the tools that you've been able to do it. You know, seeing that on your phone, seeing that on your computer at work, being a bit more efficient. That's going to benefit everyone, isn't it? Everyone's going to be slightly more efficient. Some companies are already using it to help as well. I think Walmart did a big exercise of using AI to be able to check all the prices and things and see if they're efficient, and it's actually been profitable for them already doing that. But there's countless stories of programmers who are sadly losing their job at the moment because instead of having a team of 20, they're going with a team of 5, and they're adopting AI on top because you've got AI writing the code for you nowadays and stuff. So I think there's definitely going to be positives and negatives. You can see that some people are sadly going to be losing their job on the back of this because companies are trying to be more efficient. And back to if your national insurance is going up, anything lever that you can pull to be more efficient is going to be help the business. So we'll see. It's still early days. We still haven't got through there. We at Luna, we just started to use our first AI tool. Or at the moment, we've used ChatGPT a couple of times, but just as a test to see if it was any good. But now we're going to use an AI tool to record our meetings, like do a transcript for us afterwards and things. Just
meeting notes.
Exactly, just to be slightly more efficient and things like that. And that's a relatively cheap tool, which is going to make us more efficient as a business. So it will come.
You could have used that to summarise this presentation.
It could have done. Could send it around to everyone. So we'll see. It's still early days though, and as I said, the news overnight as well. That's just added another complexity to it. But if it means that it's cheaper for everyone to use, and it's going to be a benefit. I mean, it's impacting the market at the moment because those companies that have been seen as the darlings of AI, share prices have done phenomenally well, and they've been bid up and become such a large part of the market. But over time, the top company doesn't tend to stay the top company in the US market. If you go back over 10 years ago, it was different business, etc. So things change and things move on.
Okay, Chris?
Yeah, I think as you said, Alex, it's potentially just taking those tasks that could be done more efficiently and making them more efficient. And there will be sectors or jobs which do become redundant, but you look back through history, and that's what happens as technology develops. Certain things become not needed, but then it often opens up opportunities for new sectors. So I think as you said, there'll be positives and negatives, but I think if it does make businesses more efficient, if it means they can potentially offset some of that cost pressure from national insurance rises, then I think it can be a good thing. But yeah, it's still early days. We've sat down with a company looking at a similar tool to yours, and I think in the long run, I think it will be beneficial because my favorite thing is sitting down with clients, and if I can do more of that and have an AI tool doing some of the other jobs, then great. So
taking a lot of that manual processing, repetitive manual away from us to allow us to be in front of clients.
Absolutely.
So good, thank you. I think that's all the questions and answers unless anything else comes through. Alex, I'm conscious of time. Would you just like to give a brief 30-second summary with regards to what our listeners should be thinking about with regards to investments?
Yeah, I think the first thing I'd like to highlight is that we're optimistic. We're optimistic about markets. You're looking at bond markets, which look attractively valued at the moment. Interest rates are going to be coming down through this year. That's a good period for bond investors. There are pockets of the market in the equity market that look a little bit expensive, so you've got to be careful about where you're investing. Don't have all your money in Nvidia because, like we saw last night, you never know when these events are going to come through. So be diversified, but there's certainly opportunities within equity markets as well. And look, we touched on the global economy. Looks like it's in a pretty strong state, principally driven by the US. UK economy is going to be a bit more stodgy. You can see inflation, which is a bit sticky, but you're not seeing us going into recession. We think economic growth is going to be positive this year. So that a good 30-second summary of the world.
And Chris, a quick summary.
Yeah, I think probably now's a better time than ever to just again go through a bit of a full-on review, both personal, business, head to toe. Wills all the way through to investments and IHT planning. I think there's been a lot of change in the last year, but especially in the last few months. So, it's important to make sure that you are adapting, and it might be that, you're not making any immediate changes, but it's planning ahead that, when these new changes come in, what are we going to do? There's no surprises. And actually, I think it's a good time to be thinking about, we've had a good couple of years in the market to nearly try and remember it's not always like this. A bit of a lifeboat drill that, reminding clients there will be a time probably in the next couple of years where we're going, what's going on? The world's falling around cars, and remembering that, it does then get back to the good times, but you just have to, stick through it. So now it's better than ever to kind of nearly remember the bad times to not panic when those times come.
Okay, good, thank you. The only thing I would stress also, you mentioned national insurance contributions increasing. There are ways that we can help companies mitigate those increasing national insurance contributions by reviewing certain things such as employee benefits. We've got our own employee benefits department. We're working with accountants and their clients, and also our own private owner managed businesses that we work with, to look at reviewing their employee benefits to see if there are savings that we can make on national insurance in the way that you make contributions into a pension to mitigate the increase in NI. So, good, thank you. So again, everyone, thank you for dialing in today. Alex, Chris, thank you for your time. I know it's you're both busy people. The next quarterly investments seminar will be held on the 22nd of April, just after the spring forecast, spring budget, and 26th of March. So there'll probably be some more changes and some more news that we'll have to adapt to. If there's anything you'd like covered in our quarterly webinars, please feel free to speak to your advisors, feedback to myself, Chris, or Alex, and we will try and address any questions where we possibly can. So again, thank you for your time today, and we hope you can all join us in April.
Thank you. Cheers, guys.